Good evening. I am Sharon Wyatt from Chicago Public Library Civic, Cultural, and Literary Engagement Team. Welcome to this evening's program, Changes in Tax Law. Know before you file. This program is part of our Law at the Library live events hosted by the Chicago Public Library and Evanston Public Library. We want to help patrons understand the complicated nature of legal information better by providing reputable experts to lecture on legal topics and address questions. The Chicago Bar Association is presenting this program, and we want to thank them for giving their time to educate the public on this vital issue. Today, we're pleased to welcome Robert Hovey to speak about changes in tax law. After the conversation, we'll take questions from the audience. So we invite you to leave your comments and questions in the chat. Now it is my pleasure to introduce Robert Hovey. Robert started in public accounting in 2018, working primarily in tax, and is a licensed certified public accountant. Robert is currently employed at Forvis, formerly known as BKD, in their private client service department, where he works on individual and business tax returns, along with trust, estates, and gift tax returns. Robert has been a law student at UIC Law, formerly known as John Marshall School of Law, since 2021. He is a Chicago Bar Association Young Professional Federal Taxation Committee member. He is also a member of the Illinois CPA Society and the American Bar Association. Please join me in welcoming Robert Hovey.
Thank you, Sharon. Good evening, everyone. I hope you all had a great holiday and New Year. But even though the holiday season may be over, luckily for us, tax law is the gift that keeps on giving. So we have a lot to discuss today, and we can start with the agenda. So the agenda tonight is going to be U.S. federal and Illinois tax law changes and considerations. And then we will finish with a questions and answers section. But before we move on, I want to briefly stop here for a moment. And I want you all to think about an overview of your 2021 taxes and how they might have changed or not have changed for 2022. See, now is the ideal time to take advantage of tax saving ideas to lower your 2022 tax bill, especially as many of the tax-friendly COVID-19 pandemic provisions have expired or changed in a manner that could impact your 2022 taxes. Your 2021 tax return is a great starting point. Ask yourself, what has changed for me and what has remained the same? Asking yourself these two simple questions can help you identify potential areas to discuss with your tax preparer and how some of the tax law changes in this presentation tonight may or may not relate to you in 2022. For example, you may have given birth to a new child in 2022, and therefore you may now qualify for an additional child tax credit. So tonight, there's not necessarily a need for you all to fully grasp these new tax law changes. Rather, by simply documenting changes in your own tax scenario can help you identify areas to communicate with your tax preparer that may offer some tax advantages. Starting with the U.S. federal tax law changes, the most significant piece of federal tax legislation was the Inflation Reduction Act of 2022, signed by President Biden in August. A brief summary of the changes are: for individuals, the act extends the limitation on pass-through business losses and extends the health insurance premium tax credit. For certain corporations, the act imposes a 15% minimum tax on corporate book income and creates a 1% excise tax on stock buybacks. The act also modifies, extends, and creates a variety of tax credits for green energy and raises taxes and fees on the fossil fuel sector. I've included here a link here that is a link to the official whitehouse.gov page. And this page offers an interactive experience to see how you as an individual may qualify for a variety of these tax credits for green energy. And lastly, it imposes an excise tax penalty on drug manufacturers to lower drug prices, and it increases the research and development tax credit claimed against payroll taxes for small businesses. And for clarity, I have grouped other federal tax law changes and inflation-related adjustments throughout this presentation, but I have indicated which areas originated from the Inflation Reduction Act. The tax brackets. The IRS announced the tax year 2022 annual inflation adjustments for the tax rate schedules. Notice the tax rates themselves are not changing. So as you can see here, the 10%, 22%, 32%, et cetera, are still the same. But what changed is the tax bracket amount. So as a result, you could end up in a different tax bracket in 2022 from 2021, depending on your filing status. So that, of course, would mean that you would pay a different tax rate on some of your income. For example, for single filers, the 22% tax bracket for the 2022 tax year starts at that $41,776. However, in 2021, that 22% tax bracket started at $40,526. Tax rates on long-term capital gains, and so that would be gains from any sale of capital assets held for at least 1 year, did not change for 2022. However, similar to the tax brackets that we just discussed, the income thresholds for the various rates were adjusted for inflation. And remember, the sale of stocks, bonds, cryptocurrency, real estate, and other capital assets are applicable to the capital gains to capital gains from that sale. And in addition, for 2022, those capital gains may be subject to the net investment income tax. And that is an additional levy of 3.8% if the taxpayer's income is above a certain amount. Excuse me. The standard deduction amounts were increased for 2022 to account for inflation. The standard deduction for married couples filing jointly for the tax year 2022 rises to $25,900, and that's up $800 from the prior year. For single taxpayers and married individuals filing separately, the standard deduction rises to $12,950 for 2022, and that's up $400 from the prior year. And lastly, for head of households, the standard deduction will be $19,400 for the tax year 2022, and that is an increase of $600 from the prior year. Moving towards itemized deductions. So still for 2022, medical expenses are still deductible only to the extent they exceed 7.5% of AGI, and that's for all taxpayers regardless of filing status. So such medical expenses such as health insurance premiums, long-term care insurance premiums, and dental insurance premiums. And remember, long-term care premiums are deductible to a certain amount per year, depending on the taxpayer's age before the close of 2022. So if that applies to you, make sure you discuss with your tax preparer those limitations. And there's still currently in 2022 a $10,000 cap on deducting state and local taxes, but there is a PTE workaround if you're an owner of an S Corp or a partnership that we will discuss later when we speak about Illinois changes. And remember, a pledge to make a donation is not deductible unless it is actually paid by the end of 2022. However, you could have made a charitable contribution by the end of 2022 using a credit card, even if the bill will not be paid until 2023. And lastly, the above the line deduction for up to $300 of charitable cash contributions, that was $600 if you're married filing a joint return, that expired at the end of 2021 and is not applicable to 2022 anymore. Other deductions, starting with certain expenses for elementary and secondary school teachers. So for 2022, teachers and other educators who buy books, supplies, COVID-19 protective items, and other materials used in the classroom can deduct up to $300 of those expenses. And that was $250 in 2021. And that maximum deduction for 2022 jumps to $600 for married couples filing a joint return if both spouses are eligible educators. Taxpayers can still be eligible for an above the line deduction for student loan interest, and the maximum deduction is $2,500. However, the deduction for 2022 begins to phase out for income exceeding $70,000, $145,000 for joint returns, and is completely phased out for taxpayers with modified adjusted gross income of $85,000 or more and $175,000 if you're filing a joint return. And another consideration are IRA donations to a charity. So if you are at least 70 and a half years old, you can make direct contributions from your IRA to a charity of up to $100,000 during 2022. But you cannot claim a charitable contribution deduction for those items. Conversely, though, the amounts are not included in your taxable income, and they can be used to satisfy your required minimum distribution. So you can consider this if you cannot itemize a charitable donation because, say, for example, your standard deduction is greater than your itemized deductions. So this could be a way to still contribute to your favorite charity in 2022. Moving to business deductions. We still have the qualified business income deduction, the QBI deduction. And this is for individual taxpayers with qualified business income from a pass-through entity, such as a partnership, S corporations, LLC, or even a single member LLC, or a sole proprietorship may be entitled. The 2022 deduction is equal to the lesser of the deductible amount of the QBI, or 20% of net taxable income from the business. And I included the home office deduction because work from home in 2022 is still relatively prevalent. And this deduction is for self-employed individuals and small business owners, but this is not available for employees. So if you're an employee of a company and you are using your home office, this does not apply for you. So this rule states that expenses for using the home office as a business office are deductible if the home office is used regularly and exclusively under this test stated in the PowerPoint here. But I really want to drive home the regular and exclusive part of this provision, because the exclusive provision is somewhat hard to reach. But if you do believe that you may qualify for this deduction, this can be discussed with your tax preparer. And in your situation, it can be ran through this test to meet these two prongs. But I will also highlight, if you are eligible for this deduction, and down the road you end up selling your home, you could lose some of your 121 exclusion on the sale of your home because you will need to recapture some of the depreciation taken on the home office deduction line item. Still moving with business deductions, depreciation and section 179 expense election. If the taxpayer is in a business and they purchase equipment, they may either depreciate such equipment or make a elected 179 election. So that allows the taxpayer to 100% expense the item. And for 2022, the allowable deduction is $1,080,000 with the phase out beginning at $2.7 million. Bonus depreciation is for business or investment property placed in service in 2022. And this includes certain use property that may be eligible for a 100% bonus depreciation deduction. And this is separate from your 179 expense election as stated prior. But I want to note this because taxpayers should take advantage of this opportunity while they still can, because the bonus depreciation rate will decrease substantially throughout the years as we move forward, and it will decrease from 100% to 80% for property placed in service in 2023. And that I will note that certain states, including here in Illinois, they have decoupled from bonus depreciation rules. So if you do take bonus depreciation on your federal tax return, if on your federal a business tax return, that would have to be added back to your state return, as since Illinois has decoupled from that rule. And moving forward here, lastly, with some other business deductions, NOL carryback and carry forward period. Generally, a net operating loss arising in 2022 may not be carried back and must be carried forward. And the limitation on excess business losses of non-corporate taxpayers through the Inflation Reduction Act. So the Inflation Reduction Act extended the excess business loss limitations, and an excess business loss is the amount by which the total deductions attributable to all of your trade or businesses exceed your total gross income and gains attributable to those trades or businesses, plus an added threshold amount adjusted for cost of living. And generally, these threshold amounts are $262,000 or $524,000 in the case you're filing a joint return. So then we'll move towards a business tax credit. And the Inflation Reduction Act extended the qualified small business payroll tax credit for increasing research activities. A qualified small business is one that has gross receipts of less than $5 million. However, this applies to tax years beginning after December 31st, 2022. And in addition, qualified small businesses may also apply an additional $250,000 in qualifying research expenses as a payroll tax credit against the employer's share of Medicare. And some other business information. As many of you may recall, for Paycheck Protection Program, for the PPP loans and other types of loans provided to businesses during the pandemic in 2020 or 2021, forgiveness or cancellation of all or part of such loans will not be treated as income for tax purposes in 2022. And in addition, the employee retention tax credit. Businesses can no longer pay wages to claim the ERTC, but they do have until 2024, and in some instances 2025, to do a look back on their payroll during the pandemic and retroactively claim the credit by filing an amended tax return. And I do want to know that expenses used to create the ERTC refund are not deductible and must be disallowed in the year to which the credit relates and not in the year in which the cash refund is received. So now we'll come back to individuals and specifically tax credits that relate to individuals. And we have a lot of these to discuss tonight because the Inflation Reduction Act created a lot of green energy tax credits for individuals. But first, we're going to start with the child tax credit. The child tax credit was one of the most dramatic changes in tax law in 2021 and in prior year. And the expansion of the child tax credit, or the CTC, was that the credit amount was increased, the credit was made fully refundable, children up to 17 years old of age qualified, and as many of you may have received, half the credit amount was paid in advance through monthly payments from July to December of last year. President Biden and Congress tried to extend these enhancements for at least one more year. They have not been able to get that done thus far. So for 2022, families claiming the CTC may receive up to $2,000 per qualifying child under the age of 17. The maximum amount of the credit that could be refundable is $1,500 per qualifying child. And you must have earned income of at least $2,500 to take advantage of the credit's refundability. The credit phases out for taxpayers with adjusted gross income levels above $400,000 for married filing jointly and $200,000 for all other returns. And unlike in 2021, there are no advance payments to the child tax credit, and 17-year-old children will not qualify for the 2022 tax year. But there is the other dependent credit, and this is a $500 non-refundable credit for dependents other than qualifying children, which is available in 2022. So for example, this would be a child over the age of 17 or an elderly parent living with you who qualifies as a dependent. There is no age limit, but the dependency test must be satisfied. The household and dependent care tax credit. You may be able to claim a credit for household and dependent care expenses. Expenses such as daycare, nursery school, before and after school care, and even summer camps. As long as you paid such expenses for the care of a qualifying individual under the age of 13 to enable you, or if you file a joint return, your spouse, to work or actively look for work. The maximum credit for the 2022 tax year is $1,050 if you have one child or dependent, or $2,100 if you have more than one child or dependent. This amount is only allowed for families making less than $15,000 a year in 2022, and that was $125,000 in 2021. So we see actually an increase in eligibility. So for 2022, the child and dependent care credit is non-refundable. The earned income credit. The following amounts are used to determine the earned income credit as adjusted for inflation for tax years beginning in 2022. Remember the excessive investment income exception, which states that for tax years beginning in 2022, the earned income credit is not allowed if the amount of certain investment income exceeds $10,300. The 2021 enhancements expired, such as the childless EITC amounts were higher. For 2022, they plummet from $1,502 to $560. The maximum age limit of 65 years old, which was eliminated in 2021, is now also back in play for 2022. And the minimum age for childless worker to claim the EITC jumps back up to 25 for 2022 tax year, and that was 19 for 2021. And lastly, the expanded eligibility rules for former foster youth and homeless youth that applied in 2021 are also dropped as well in 2022. And in addition, the rule allowing you to use your 2019 earned income to calculate your EITC if it boosted your credit amount no longer applies for 2022. The premium tax credit helps eligible Americans cover the premiums for health insurance purchased through an Obamacare exchange. In 2021, this credit was enhanced to lower premiums for people who buy coverage on their own. Such enhancements were that you were considered to have met the premium tax credit's household income requirements for the 2021 tax year if you or your spouse, in the case of a joint return, received or approved to receive unemployment compensation for any week in 2021. The Inflation Reduction Act in 2022 extended most of the premium tax credit enhancements through 2025, but unfortunately though, the relaxed eligibility requirement for people who received unemployment compensation in 2021 was not extended to 2022 or beyond. But on the other hand, it did still expand eligibility of taxpayers with household income over 400% of the federal poverty level through 2025. Now, getting into the green tax credits, we'll start with the residential clean energy credit. And this credit was renamed, and it used to be called the residential energy efficient property credit. But now It's called a residential clean energy credit. And this tax credit is available to taxpayers who install certain energy efficient property, such as solar electric property. And the amount of the credit is 30% of the cost of qualifying property. And that was formerly 26%. And the credit is available for property installed on or in newly constructed homes and existing homes. The non-business energy property credit, which had expired at the end of 2021, is now revived for property installed in 2022 and later. The credit amount is 10% of the cost up to a $500 lifetime limit for purchases of certain types of energy efficient equipment for your principal residence. That is such energy efficient equipment such as installation, windows, doors, roofing, and similar improvements. There is a $200 lifetime limit for windows, and the 2022 credit is unavailable for improvements to a newly constructed home, a second home, or a home outside the United States, or a home that you rent rather than own. But you may want to defer making any energy efficient improvements because starting in 2023, this credit is going to be greatly expanded. And it's now going to be equal to 30% of the cost of all eligible home improvements installed during the year, with no lifetime limit on windows. The $500 lifetime limit will be replaced with a $1,200 annual limit, and the credit will be extended through 2032. However, roofing and air circulating fans were no longer qualified for the credit. But to qualify for the 2023 credit, residential energy property must be installed on or in the connection with the home in the United States that you use as a residence. However, this residence does not have to be your principal residence, so it could be a second home or some other type of vacation home. More green energy tax credits. The qualified plug-in electric vehicle credit may be available if you purchase a plug-in electric vehicle, such as a passenger vehicle or a light truck. The maximum credit allowed for a vehicle is $7,500, and this credit is non-refundable and has some income phase-out limitations. However, for 2022, there is an assembly requirement to this credit. So if you purchase an electric vehicle between August 17th and the end of the year, you will not qualify for this existing credit if your vehicle was not finally assembled in North America. But starting in 2023, this credit will be renamed the Clean Vehicle Credit, and this will be available for plug-in electric vehicles with battery capacity of at least 7 kilowatt hours and fuel cell vehicles. But the credit will be more difficult to qualify beginning in 2023 based on some modified adjusted gross income limitations. But if all the requirements are satisfied, the maximum credit for 2023 is going to be $7,500. And also beginning in 2023, for buyers of used plug-in vehicles and fuel cell vehicles, the credit amount is $4,000, and that's limited to 30% of the vehicle's purchase price. The alternative fuel property tax credit originally expired on December 31st, 2021. However, the Inflation Reduction Act extended the EV charger tax incentive for 10 years, so through December 31st, 2032. If you install a home EV charging station, the tax credit is 30% of the cost of hardware and installation, up to $1,000. And businesses that install new EV chargers or EV charger equipment can also benefit from a tax incentive of up to 30% of the total cost of equipment and installation. The limit on the amount of the EV charger tax credit for businesses was $30,000 in 2021. However, under the new law, if you complete the business installation project after 2022, the tax credit per property item is going to be up to $100,000 per EV charger. Moving towards IRAs and individual accounts. For a simple IRA, the annual deductible contribution limit for 2022 is going to be $14,000 plus an extra $3,000 for individuals age 50 and up. For the traditional IRA, the deadline for 2022 contributions is April 18th, 2023, for the contribution to be considered a 2022 contribution. The annual deductible contribution limit for an IRA is $6,000 plus $1,000 as an additional catch-up contributions, only for individuals aged 50 and up. And deduction phase-outs for traditional IRAs also start at higher levels in 2022. The Roth IRA. This type IRA allows individuals to make non-deductible contributions of up to $6,000 plus $1,000 as an additional catch-up contribution for individuals age 50 and up for 2022. However, a Roth IRA must be established and funded by April 18, 2023 for the contribution to be considered a 2022 contribution. However, also, the income ceilings on Roth IRAs contributions also went up. And you can also still consider, if you're a high income taxpayers, for a Roth IRA conversion. And in the case of this will arise if you think your future tax bracket will be higher and you expect your income to keep increasing. A Roth IRA conversion is a way to convert funds from your traditional IRA at your current tax rate and then withdraw them tax-free at retirement. And then IRA rollovers for 2022, you may only make one IRA to IRA rollover per year. A second attempted rollover in 2022 will be treated as a withdrawal and taxed at regular rates, plus a possible 10% early withdrawal penalty. And lastly, the IRA required minimum distributions. If you are turning 72 in 2022 and taking your first RMD, you have until April 1st, 2023 to do so. And some other tax law related information. We will start with the student loan forgiveness. The much anticipated student loan forgiveness was when Biden announced that he'll be using executive action that will wipe out $10,000 in federal student loans for borrowers earning less than $125,000 per year and $250,000 per year if they're married filing jointly. For certain student loans, forgiveness or cancellation of all or part of such loans will not be treated as income for federal tax purposes. However, forgiveness of cancellation of all or part of such loans may be treated as income for state tax purposes, depending on your specific state's rules. For us Illinois residents, Illinois has conformed with the federal tax law regarding this, so they will treat any type of forgiveness or cancellation of federal student loans as non-taxable. Again, it's going to be non-taxable. However, though, his plan is facing two major legal challenges that are scheduled before the Supreme Court in February. So as a result of that, the Education Department announced that it extended the ongoing student loan pause into 2023 in response to legal challenges of President Biden's student loan forgiveness program. 1099-K forms. There has been a lot of flip-flop on this, and I'm sure many of you who have a business that uses eBay, Venmo, Cash App, or if you have a so-called side hustle that uses that eBay, Venmo, Cash App, you might have been made aware of this for 2021. And that's because back in 2021, they changed the tax law starting in 2022 that third-party settlement organizations such as eBay, Venmo, and Cash App would now have to start reporting transactions over $600 per year, regardless of the number of transactions. And that was changed from the previous threshold of more than 200 transactions per year, exceeding an aggregate amount of $20,000. So this was a pretty drastic change. And I will note, though, that this law is not intended to track personal transactions such as sharing the cost of a car ride, or meal, or birthday, or holiday gift. But, however, the IRS announced about a week ago that they're going to delay the reporting threshold for 2022. And so for 2022, it's going to be under the previous threshold that stated their third parties will not report anything unless there's 200 transactions per year exceeding an aggregate amount of $20,000. But moving forward to 2023, as of today, you're going to be under the new reporting threshold of $600. Now, this is very drastic. It took many people by surprise, and it's kind of a heated topic. So I could see that this $600 amount changing for 2023. I've seen Democrats proposing to go $5,000. However, Republicans are proposing to go back to $20,000. So this may change again. And I will note that the law is written to state that Chase QuickPay or Zelle are considered bank-to-bank transactions, so they're not considered third parties payment processors for this tax law. And moving towards Illinois tax law changes, we still have a 4.95% flat tax rate for individuals. The personal exemption amount for the tax year 2022 is $2,425. But what is new is the Recovery and Mental Health Tax Credit Act. This legislation was addressed for the continued impacts of the pandemic, the current workforce shortage of the current workforce shortage crisis. And this provides that a qualified employer tax credit of $1 per hour worked per eligible employee, up to $2,000 per employee hired and retained for a minimum of 500 hours during a tax year. The total tax credit allocation for all employers during the year is $2 million maximum. The qualified employer would be required to provide a supportive recovery environment for the employee and collaborate with mental health and substance abuse disorder treatment providers or facilities, and require a professional diagnosis of the condition and recovery of the employee. And as discussed previously, and was new last year, and is very prevalent, and starting with the 2022 tax year and ending in 2025, will be the pass-through entity taxation. The Illinois PTE is a variable that any non-publicly traded partnership or subchapter S corporation filing an Illinois income tax return. However, be sure to note that the PTE workaround only applies if you have an ownership of an entity taxed as a partnership or an S corp. It does not apply to sole proprietorship. So in Illinois, a PTE is made on an annual basis, but is irrevocable for each year made. And individual owners of the pass-through entity making a PTE can claim an income tax credit for the share of the pass-through entity state income tax paid by the entity. And for Illinois, the credit equals 4.9% times the partner or shareholder's share of an entity's net income. And I will note that this deduction is tied to the SALT cap, which is set to expire in 2025. And if it is removed before then, the PTE deduction that I spoke about would also go away. Okay, we'll now move towards the questions and answers section. Looks like we have about roughly 20 minutes remaining, so we have plenty of time for me to answer any questions. And I believe we can just start with what's in the chat.
We have some questions in the Q&A.
Okay, yep, okay, I'll look in the Q&A. Okay. So let's start with this. Healthy Me 63. For the federal tax form, can a person who will be 65 after the 2023 deadline to file still place a check mark on the age 65 and over box? And what is the federal tax rate 2023 rate change for 65 and over? So I'll start with that second prong. So there is no federal tax rate for ages 65 and older. The federal tax rates are going to be depending on your filing status. So it's going to be dependent on if you are filing a married jointly return, or a married filing separate return, or a filing single return. So in essence, the tax rate has nothing to do with your age. Now, for the first prong, if I understand it correctly, if you will be 65 after the 2023 deadline, can you still place a check mark on the age 65 and over box? So if I'm understanding correctly, I think you're referring to the 2023 deadline as the 2023 deadline to file your 2022 taxes. So that check mark is applicable to the 2022 year. So if you were 65 years or over in 2022, then yes, you can place that check mark. But if you are turning age 65 and over in 2023, you will actually check that mark in 2024 when you file your 2023 taxes. Gail Kelly, I thought the age for RMD was just raised to age 73. I believe, Gail, that you are referring to the Secure Act 2.0 that just passed last week. And as far as I'm aware, that may take place in 2023, but I thought that it actually was starting in 2024. So I don't have a great answer for you on that specifically, but generally speaking, I believe they raised that starting in 2024 tax year. And Gail, for you and for everyone else asking a question, I'll also invite you all. I have my contact information located on the first slide. And if anybody wants to send me a follow-up question, feel free to shoot me an email. I can always point you in the right direction or try to answer your question the best I can. But again, Gail, I believe that RMD was raised to the age of 73 starting in tax year 2024. The anonymous attendee, if a rental property was sold for a capital loss and the loss is greater than annual deduction limit, can the balance of loss be taken annually every year up to? Yes. So an NOL can be carried forward indefinitely, pretty much carried forward indefinitely. There are some income limitations. So if you're a high income earning taxpayer, you might be under some limitations, but generally you can carry forward that loss to an indefinite time period until the loss is taken out. An anonymous attendee, what are the qualifications for a simple IRA? I will have to point you to that would be a good question for your taxpayer. That's a long list of qualifications. I did not include that in the presentation, and I also don't know them all off the top of my head, but a quick Google search, or if you want to email me a follow-up to that, I can give you a comprehensive list. For the green tax credit related to the electric cars, is the credit phased out as income levels rise? Yes, they are phased out as income level rises. I believe I included that. I don't know if I included the schedule, but if you are thinking about buying an electric car in 2023, you can definitely speak to your tax preparer about that, and he will have further information how your individual taxable income relates to the income thresholds for that tax credit. Our condo had an exterior masonry project, which we had to pay out of pocket approximately $10,000. Will this qualify as an environmental green tax deduction? If the masonry project is considered a qualifying project, I don't know if a masonry project, I'm assuming you mean brick by that. I don't know if that's considered a project. However, I will definitely bring that question to your tax preparer and they can assess that specific project. I know the examples I included were some roofing, windows and doors, but those are just some examples. So I just don't know for sure if some of the brick would qualify, but I would definitely bring that question to your tax preparer and they should be able to give you more detailed analysis on that. It sounds like there are no deductions for charitable contributions. Is that correct? Shirley, thank you for your question. That was just pertaining to just the $300 for 2021. They offered a $300 above the line charitable contribution deduction. In 2022, that above the line deduction is no longer there. However, though, the charitable contributions for the itemized deductions are still in place for 2022. So I was just referring to the above the line $300 charitable contribution that you're allowed to deduct in 2021. Rebecca, my husband and I sold our primary residence in Illinois and moved to New York State. Will sale of our home be taxable in both states? Rebecca, thank you for your question. I do not know New York State tax law when it comes to that, but I will give you generally, selling your primary residence in Illinois, you have a 121 exclusion gain. And I want to say that exclusion gain, actually, I don't want to give you a dollar amount, so I don't know off the top of my head, but normally you should have adequate amount of exclusion to not have to pay tax on that primary residence. But Rebecca, this is a great example of a change in your tax situation from 21 to 2022 that you can identify here. And this is great that you're identifying it. You can bring this to your tax preparers so they know that this happened. But I want to say generally, I don't know many instances where people pay taxes on their primary residence because that exclusion amount is so high for owners of the principal residence. Are nursing homes cost tax deductible? Yes, you could get a credit for the long-term care tax credit as discussed. But again, that is also limited to any type of some income thresholds. So again, great question, great great point to identify for your tax preparer. I would suggest having those amounts, having those receipts, or knowing that number, or knowing what that number is. And you can possibly definitely qualify for the long-term care tax credit for that. Are solar credits phased out based on income? Yes. Yeah. All the solar credits are phased out based on income for 2023. I have moved from Wisconsin to Illinois in December. Are there any resources to help navigate changes in our state return? Yeah, there's a lot. Your tax preparer can handle that situation. There are a lot of resources out there. If you want to email me, I could point you to some state, some of us, our SALT departments, our state and local tax department, often has some great literature, especially in Wisconsin, Illinois, since it is kind of common, especially for the Midwest area for residents to move interchangeably amongst states. So there are a lot of resources. That's a great thing to identify as a change for your 2022 taxes. And is a gain on sale of your principal residence tax-free? Again, generally speaking, yes, there's a 121 a gain exclusion for residents of principal residence. Again, that's great. It's a great taxable event to identify and speak to your tax preparer about. But again, generally speaking, yes. I don't know many circumstances where I've seen people pay taxes on their principal residence, but because that exclusion gain is so high. Is it safe to file your taxes electronically? I know the IRS has a simple filing, electronic filing system that you actually file directly on the IRS website. If you're below a certain income threshold, if that's where you're referring to. Yes, that is definitely safe and secure. As far as some other programs, such as like TurboTax, I generally will say yes. I haven't heard of any type of any breakdown in the safety of filing those taxes electronically. I would just only suggest if you're using those third-party sites to really take your time with that if you're preparing it for yourself, and make sure you have all the information because I've heard of some instances that if you have to amend a return on those third-party sites, they can get kind of tricky. But I would say if you're referring to directly on the IRS website, yes, that's safe to file. And TurboTax, yes, it is safe to file electronically. I would just again highlight that if you are going to use third-party sites such as that and prepare it yourself, really take your time, really make sure you have all the proper documentation because, trying to amend a return on your own through those sites, from what I've heard could be quite the task. But how much should you pay a tax preparer for a simple tax return? Well, I'm not really sure if I know what the going rate should be. I really don't have a number for that. I think that, based on a very simple return, couple $100, if the person, again, if the person's qualified CPA and they're at a, reputable firm, I think it's worth to pay that couple $100 because, they're most likely going to do it right. And they're going to have, you can have a nice correspondence with them. And I think it, could be definitely worth to pay. But I would say generally for a simple return, a couple $100. I've heard as low as people's minimums being $250, and I've heard some people's minimums being $550 for that. And for the smaller mom and pop 1040 shops. Now, obviously, the bigger firms are more expensive, but that's a kind of rough estimate of what I know off the top of my head. But I really don't have a going market rate for a simple tax return for you. Rebecca, you mentioned the health insurance premiums can be taken as part of medical itemized deductions. For family that takes the PT insurance credits deductible amount calculated based on premium the premium amount or the amount the insurance company received. Rebecca, good question. This is again a lot of facts and circumstances intensive. I can say generally the deductible amount is going to be based on the premium amount. And not so much the amount the insurance company received. But again, this is a good fact-intensive inquiry to bring your tax preparer just to ensure that all the facts and circumstances fit in that situation. But again, generally, I would say that the credit is based on the amount of the premium. What is the capital gains tax in 2022 and 2023? So the capital gains tax rates are, the 0, 10, 15, and 20% for very high income earners. And for 2022 and 2023, really the only things that will change is the actual amounts. So if we just we're on time, but it's just the amount. So because the amounts are adjusted for inflation, but the tax rates will remain the same. I'm not aware of any changes in the 2023. And what is the federal tax on dividends? Ordinary dividends are at the ordinary rate, generally speaking. And can you go to H&R Block with a completed tax return and ask them to transmit? Any idea what the charge would be? I do not know about H&R Block, what the procedures are or how much they charge. So really, I think that it would be a better resource to call them and ask them that question. I don't have much experience with H&R Block.
All right, do we have any more questions for Robert? If you want to get in touch with Robert, you can email him at robert.hovey@forvis.com, FORVIS.com. Robert, can you show them your first screen?
Oh, yep, I will. Yep.
So if you want to get in touch with Robert, Mr. Hovey.
Yes. So so there's my email right there, robert.hovey@forvis.com. So again, if anybody has any follow-up questions or want any clarification, I can always try to answer the best I can. Or we have a vast amount of resources that we produce here in-house that I can send you links to hopefully help answer your questions.
So that's all we have time for this evening. Thank you so much, Robert, for such an informative presentation. And I want to thank the attendees for asking such great questions. Those were great questions.
Yeah.
And I want to thank the Evanston Public Library and the Chicago Bar Association who helped put this event together tonight. Our Law of the Library seminars are they're provided via Zoom monthly on various legal topics. Please share word among your networks, and you can check and register for those other seminars on the Chicago Public Library website. Have a good night.
Okay, thank you, everyone. Thank you, Sharon. Everyone have a good night.